Hello, everybody. I am back here with Ryan Detrick, Chief Strategist with the Carson Group. And as always, my name is Steve Rose, Certified Financial Planner with Art of Wealth Management. I have to make sure I get that in. Ryan, thank you as always for joining us. This is a interesting time, and we got a lot to cover. So thanks for sharing a few minutes of your time with us.
No, it's an honor, Steve. Get to come back and do this. And I will say, I don't want you to get in trouble with compliance. It's Chief Market Strategist. We love
Oh,
titles around it. It's okay. I don't care. I'm not offended. I just want whoever approves this, Chief Market Strategist. But no, it's always an honor to do this. I love talking with you about the markets and trying to help your clients that are watching us understand or do the best that we can to understand all the crazy stuff that's out there. But it still looks pretty good to me. So that's the quick summary. But let's dive in, man. I'm looking forward to it.
cool, cool. Well, that actually, you kind of queued it up perfectly. So before we started, you and I were chatting, right? Sentiment feels a little bit like it's shifted, especially the past 2 to 3 weeks. And, it's headline soup. There's no shortage of scary things floating around out there. Give us your guys' kind of point of view as how you're viewing things despite all these wild headlines.
Yes, great question. From a sentiment point of view, we've been seeing this for a couple of years now, where consumer sentiment is quite low, right? Some of the lowest, literally, like consumer confidence, for instance, Steve, is like lower now than it was during a 100-year pandemic when we shut the economy down and the stock market crashed 34%. That to me, that seems like something's a little bit off there, but that's what we've been seeing. Yet the market's strong, retail sales are strong, number of people going through TSA is strong, flights are strong. So it's this dichotomy where people feel one way but they do another. And we've been seeing it for a while. So it's kind of where we are. But you think big picture, just the headlines. I mean, just the headlines, government shutdowns, potential issues in the Middle East, obviously Washington drama, concerns about AI coming in, potentially taking people's jobs and doing these things. These are some scary, scary, legit headlines. And then the question now becomes, well, how in the world is the United States stock market like 2% from all-time high? The rest of the globe literally is hitting like all-time highs the second we're doing this. Most global stock markets are up double digits this year. Yes, the United States is not virtually flat, but we're seeing really some strong performance. How is it possible? I'll make this quick and simple. Earnings are still really strong, and it's not just in the US, it is globally. Earnings and profit margins continue to trend higher. We call those the dual tailwinds to a bull market. When you have those tailwinds, they can make up for a lot of other sins, and there's a lot of other stuff to it. But listen, we think it's because earnings are strong is why stocks have done so well.
I love that. And to kind of, continue on that discussion. So prior to this call, what we did was we sent out an email to our clients and say, hey, I'm talking with Ryan next week. What's on your top of mind? What do you want me to ask? So instead of being a mind reader, which obviously I'm not, ask my wife. So I got a couple questions here I'm going to go through and we may
Great.
kind of peel some of these apart. And just as a precursor, this video, normally we try and keep it about 10 minutes. We may go a hair longer. So, please stay with us. Here we go. Let's start at number one. So you kind of covered this one a little bit,
Okay.
and I think this ties back into earnings, but I want to just make sure we hit on this point. So the question comes in, everyone, seems like all the finance world is concerned with the market as a whole, and it's not being able to sustain its most 3-year kind of bull market run. Where do you see the gas starting to run out in this bull run?
Yeah, let's also add something. I don't know these questions. We didn't prepare this. This
No,
is the first
yes,
time I've heard that. This is off the
yes,
cuff. This is the real
absolutely,
deal. I like that. It's more authentic with my answers.
for sure.
So where let's a couple things there. First things first, the market kind of had a major peak right around Halloween last year. If you look at like the S&P 500, it's almost gone, Steve, like nowhere for 4 months. I don't think that's a bad thing. Like you just said, we had a huge 3-year run, some consolidation, and we get it. We maybe get into some of the questions. I'm assuming there's something about tech and the weakness there. But the market in a whole, you have technology that's been lagging, yes, but you have industrials that's really strong. Financials been lagging, yes, but energy and materials are really strong. So it's like this push and pull, but the lifeblood of a bull market is rotation. Right. And we're seeing some rotation. And I'll be honest, I think we're going to see rotation back into technology, back into growth, probably the second half of this year. It was just due for a break. And that's how it works. But it's not like the whole market's going down. Now, the question, where could we run out of gas? I mean, one thing that worries me, maybe a strong way to put it, but has my attention. We are seeing a lot of strength out of consumer staples all of a sudden and utilities. Now, historically, those are more the defensive areas. I'm an old school kind of market technician, message of the markets. I watch what I don't tell the market what to do. I watch what it's doing and try to interpret it. Well, if defensive areas are leading, Steve, that's maybe a warning sign, maybe some cracks, but big picture, again, the Dow Jones, last comment, the Dow Jones Industrial Average started trading on May 26th, 1896. The time we're doing this, it's up 9 months in a row. That's one of the longest monthly win streaks in the history of the Dow. The honest truth, everyone, I think we're due for some volatility. I think we're due for a little weakness. It's not abnormal. We've been very spoiled by what we've seen, but at the same time, the market's just kind of going sideways. Honestly, since like I said, Halloween, maybe it's kind of biding its time there. But I came on with you, a couple months ago. We talked about our outlook for 2026. We're still pretty optimistic, Steve. We still are. We don't think this bull market's over.
Beautiful. I love that. So let's pivot to question number two. So this one's a little bit more technical. So with the trade policies of the current administration, we've seen the devaluation of the dollar
Mhm.
of about 9 to 10% against foreign currencies over the last year. Should an investor change the way they invest in the next 12 months as a result?
Ooh, good question there. So let's a
Right?
couple things unpack there. Um, Boy, trade is interesting because a couple on Friday, a lot of the President Trump tariffs were struck down by the Supreme Court 6-3. Not all of them, but some of those tariffs are coming back. Now, what's that mean? There's $175 billion sitting out there that companies are saying, "Hey, can I have that back?" Like FedEx was like the first big company last week that says, "Yep, I think I'll take that money back now because the Supreme Court said that tariff wasn't, justified." Listen, that's above my pay grade, probably above your pay grade, Steve. We're just trying to see what's going on there. But that's what's happened with trade. But the reality, the last 12 months, the dollar has been weak, right? The dollar's down. Now, here's what I think is fascinating. You mentioned like down 10% or so, which is a big move, everybody. A 10% move over the course of a year is a really big move for a currency. Look at the dollar where it was 5 years ago, 10 years ago, 20 years ago, back in the 90s, 80s, and 70s. All right. And this is a big picture view, so visualize this. The dollar's right there. I mean, it goes up a lot, it goes down a lot. Yes, it's been weak lately, but to say the dollar is like we're losing reserve, I think this is kind of where the question's probably coming. Are
Mhm.
we losing reserve status of our currency? No, we don't think so. I don't think as long as anyone's alive listening to this, we're going to have the world's reserve currency. The other way to look at this, the kind of way we've been looking at it, if you go back in history, everyone, when the US dollar is weak, that's usually a sign money's leaving the dollar, but going into risk assets, specifically stocks. Look at 2022. Dollar was extremely strong those first 10 months. Just in case you forgot, that was a vicious bear market. The Fed was hiking, and the stock market had a 25% bear market. And other times, the great financial crisis, for instance, the dollar went up a lot. You know what happened in March of 2020 when we had COVID and we shut the economy down? The dollar soared. So when people buy the dollar aggressively, that's usually a defensive trade. Like, give me the safest, it's a cleaner shirt and dirty laundry, let's be clear. But it's the safest thing. So you buy it. So to us, this gently weak dollar that we're seeing, it's not crashing. It's just been kind of slow and steady down. Yes, some of President Trump's policies are there. The other thing on this, I can go all day, I'll wrap this up. I think the dollar has been weakish relative to other countries the last year, let's say, because the rest of the globe's economy is growing better than ours relative to expectations. If you look like earnings and GDP, that's gross domestic product, how your economy is doing, our economy is still really strong. But a year ago, nobody, honestly, like virtually nobody thought Europe's economy would do well. And I promise you this, nobody thought the European stock market would do well. And sure enough, most European countries gained over 30% last year and their economies grew more. So that's kind of what happened. Now, Sonu Varghese on our team, chief macro strategist, we're of the opinion maybe the dollar could start to strengthen a little bit here as the U.S. economy kind of comes back and takes back the baton. That's how this works. It kind of takes, a little bit of this, a little bit of that. But what should you do in a weak dollar environment? Well, something you and I've talked about, look around the globe. When the dollar is weak, the rest of the globe does a little bit better. Yes, we're US centric. Yes, we still think you absolutely should be investing in the United States. But in a weak dollar environment, you might want to own a little bit more stuff around the globe potentially. And that's kind of what we've seen over the last year. And honestly, year to date, US is up a tad, but rest of the globe still doing well. Kind of a rerun, it's hard to say, rerun, if you will, of last year.
Perfect. Yeah. And I think you and I have talked offline about this, and something we did for a lot of our clients is we made that rotation into developed European. as a
You,
play to
you
all of
know,
these
when
things
you
that are
asked me
going on.
that, I was, oh, Steve, we like it, but I wasn't too sure. That was that's worked out awesome, by the way. That
It
was a
has been
while
a
ago,
good
right?
trade. It has been
Yeah,
a
that
good
has
trade.
really
Yeah.
worked out well. So
So
I'm glad to hear that. Yeah.
yeah, I'll give you all the kudos for that. You talked us
Thanks.
into
Thank
it.
you.
So
Hmm.
absolutely. All right, next question. Do you anticipate the expected current inflation rate of about 2.7% and therefore the current policy on interest rates to drive investment choice in the near term?
Yeah, great question. So historically, they tell us the Fed targets 2% inflation. I'm not so sure that's true in this world anymore. For about 20 years, from let's say 2000 to 2020 before COVID, yes, inflation was around 2%. We've been having higher inflation since really COVID and the economy kind of kickstarted and went back up. The thing we've been saying on our team for a while now, we think we're in more of a 3% inflation world than a 2% inflation world. And it's all relative. Is that good? Is that bad? Is that better or worse? We don't think it's bad. I mean, historically, inflation, go back 150 years, has been 3.5%. So hanging out right around 3% or so, yeah, it's more than we saw for 20 years. But history would say if the inflation just kind of stays there, the market could do just fine. I mean, it's literally what we've been seeing. I mean, literally, we've talking about this bull market, earning strong, lots of positive things out there, and inflation's been running around 3%. And I don't want to get too geeky with this, but you look at commodity prices. I mean, listen, they've been going up, right? I mean, we talked about gold last time. I mean,
Yeah.
gold, obviously, a lot of commodities have gone higher. That leads to usually inflation. But there's another thing called shelter, which makes up like 40% of inflation. So it's like, how much your house is, how much rents are. And it's a complicated formula. I'm not going to get into it, but that's what the government looks at. Bottom line is a lot of deflationary pressures from shelter. So you got the one going up, the one going down. I think right around 3% inflation makes sense. Listen, if you and I do this in 6 months and inflation's up around 4%, yeah, we have probably a problem and the market's probably not going to be very happy. But we're pretty optimistic we hang out around 3%. Now, to part two to this, what's the Fed going to do, right? That's the next part of this. Fed policy. In 2022, inflation went up a whole bunch. Terrible war happened. The Fed had to hike interest rates aggressively to slow down inflation, kind of break the back of inflation, and it led to a bear market. I mean, that's what happens. We think the Fed's going to cut a couple more times later this year. We don't think they need to cut a whole bunch. Honestly, be careful what you wish for. Let's say the Fed were to cut rates a whole bunch and get interest rates real low. Well, that probably means the economy's in a lot of trouble. All right, so maybe be careful what you wish for. You don't want to get a whole bunch of cuts. So we think maybe 2 or 3 cuts from the Fed. The second half of this year makes sense as inflation kind of continues to hang out around 3%. But we just don't think inflation is going to be a massive problem in the second half of this year.
Would you say people almost get caught in the weeds a little bit, right? Like overreading inflation. And I mean, we're talking very minute
Yeah.
movements from, 2.7 to 3.5. I mean, it feels big, but in the grand scheme of the big scale, it's actually not that much, correct?
No, you're right. And that's, I think, just the world of finance, my world, your world, in general. Everybody, oh my goodness, you see jobs last month? Did you see the productivity number last month? And then, like, that's why we like to take a 3 month average, right? Over 3 month average, 6 month average, a lot of these things. Then it's like, oh, okay, well, it went up a whole bunch and it came down, but the average is there. So I think we do slice and dice it, and we could really go down some rabbit holes with inflation because there's something called trueflation, which is saying inflation is much, much lower. We're in the camp though. Put it this way. Let me put it this way. If there's going to be a problem the second half of this year, it very well, Steve, could be we have a little bit more inflation coming in than we'd want. Let's say up to 3.5%. Market might not like that because again, that means the Fed's probably not going to cut. We don't think the Fed's going to hike. Again, the Fed hikes to slow down the economy, to slow down inflation. We're not seeing any signs of that right now, but in 3 months when I come back, maybe who knows? Maybe we will. That's one potential worry of ours is maybe a little bit hotter inflation the second half of this year, but we're not seeing it now. But it's something we are paying attention to.
Okay, perfect. We'll earmark that for our next call
Yeah.
and see what the crystal ball looks like.
Yeah.
Okay, next question, and I'm going to kind of rephrase this one just because it is a very lengthy question. We don't have time to go through all of it. So let's talk a little bit about the yield curve and safe investments. And the yield curve has shifted a little bit. What are you seeing in the realm, as interest rates come down, obviously some yields come down.
Yeah.
But when we start to talk about safe investments, we've been using really short-term treasuries, money markets, things of that nature. How
Mhm.
is the yield curve kind of shifting around, change that perspective a little bit?
Well, good question. And this is where we preface things with like, talk to your financial advisor before you do anything. And
Yeah,
everyone looks at this a little differently. We think there's totally a place for bonds in a portfolio, right? You're
mhm,
talking about the short end of the curve,
correct.
the real safe stuff. Because if interest rates go up, bonds don't do well. Again, think back to 2022. If you own a lot of bonds, it wasn't a very good year. Now, again, if the Fed cuts a couple more times, I think, having some bond exposure makes sense. What we're doing in the old day, I don't know, maybe 20 years ago, Steve, maybe you can fill me in. Old days, there was a 60-40 portfolio, 60% stocks, 40% bonds. That's what a lot of financial advisors did. I guess we called them stockbrokers back then. But we've moved from that because in 2022, it really shook everybody up because we thought those bonds we owned were supposed to save us, when the market went down. In 2008, the stock market crashed, right? Great financial crisis. If you don't remember it, good for you. Or go read a book. It was not a fun time to be doing this stuff. But bonds gained 15%. I'm not saying it made up for the 40% drop in the S&P 500, but it did help you sleep at night, right? And again, what have we been seeing lately? Now, lately, let's say really since 2022. Let's call it that. But we had some big down drops in stocks. And you know what? Bonds, Steve, didn't do that much. It didn't really help you. What's going on now? I say if you drop it, hits your foot, it hurts. That's some areas of safety, right? Gold. I mean, gold's up over $5,000. A lot of these commodities have been kind of more of a safety play. So I think in that other bucket of 40%, you totally should have some bonds in there. But maybe unlike, 10 years ago or so in a little bit higher inflationary world, maybe own a little more commodity exposure, getting real geeky. We do have some managed futures and some of the stuff we look at. There's nothing wrong with having cash. I mean, cash helps you. When the market goes down a lot and you're scared, cash helps you sleep at night too. So I think have a more diversified 40% of the bucket makes sense. And again, not everybody's going to have 40%. I don't have 40% in mine. I mean, but that's what we say, 60-40. But that's kind of some things we're thinking about. I mean, the reality though, bonds make sense. I think it's kind of what the question's asking about. If we don't have a big spike in interest rates, which we just don't see. We don't see that. I mean, bonds are still going to do pretty well for you. Maybe look at a little more diversifiers though than you used to back in the old days.
Okay, perfect. And that you kind of segued into the next question I was going to,
Mm.
with this commodities run, right? It's
Yep.
been top of mind talking about gold, silver. Well,
Mhm.
can't remember the exact date. It wasn't too long ago. Silver had like a minus 20 day, right?
Yeah.
So there's volatility in commodities. So when placing commodities, like from your viewpoint, how do you measure risk when you start to look at placing commodities in a portfolio?
Yeah, great question. I guess it was on a Friday, maybe 4 Fridays ago. Silver crashed, and gold
Yeah,
honestly
something like that.
crashed too. But
Mhm.
also, it was up a whole bunch. I mean, it was up like
Correct.
65% for the year in
Mhm.
like 3 weeks. So
Yeah.
that's a stretch rubber band. It's all relative, but I think with us, we don't really own any of this the like gold stocks per se. We don't really have any silver because it is so darn volatile. But
Mhm.
with us, we've got a little bit of gold exposure and some ETFs and some things, and you can own like metals and mining, and there's some other more aggressive. But I think the key thing, what you just said, I don't think someone should have like 30% of their portfolio in gold. I mean, a couple percent here, a little bit there to add some safety and some diversification makes a lot of sense. But just remember, I mean, gold's had an incredible run, and silver at the time we're doing this, silver's still up almost 20% on the year. I mean, yes, it had a crash. It had absolutely crashed a while back, but it's still up. But here's the thing I like about commodities, much like probably my first answer way in the beginning. Other groups are taking over, right? Crude oil this time last year didn't have a very good year in terms of going up a lot. Well, crude oil is starting to move higher now. Copper is starting to move higher. Palladium is starting to move higher. It's not just gold and silver. There's a lot of other commodities that are doing pretty well. And I think to me that's a lasting bull market. You look at history, Steve. I think this gold bull market specifically, it started 2022. The terrible war happened. There were some sanctions put on Russia. A lot of people, a lot of central banks looked around and said, "Oh, you can put that on Russia. You can do that to us." So they're buying more gold. Central banks are buying a ton of gold now relative to almost any time in history, and that's one reason gold is up over $5,000 an ounce. But look in history, everyone, these bull markets last a while, like usually well over a decade. So I'm not saying every year is going to be higher, but these cycles last a while. And I think again, this commodity boom we're in, it still probably has life left to it. It maybe gets ahead of itself sometimes. And you have those vicious corrections like we saw in late January, early February. But again, the end, stock market's the only place things go on sale and everybody runs out of the store screaming. If you haven't bought any gold and or you want to own some commodities, there's going to be pullbacks. It's
Mhm.
just this does volatile. It's going to happen. Have that plan in place. Talk to Steve and make sure he's
Mhm.
okay. If we get a 10% pullback in gold, I want to add some now, but don't just chase it when it's up a whole bunch. But there's always opportunity. I think there's still time to this. And last comment on this. It's hard for me to think copper will be flirting with all-time highs if the global economy is not strong, right? China's gobbling up copper. All around emerging markets gobbling up copper. U.S., I think we have like one of the largest stockpiles of copper in our country's history as we sit here and do this right now. So those are some positive things. People always said back when, a couple of years ago, we said we kind of liked gold. We actually added some gold back in 2023 when we thought the market would go up. I said we could be at a period for years where gold and stocks go higher together. People looked at us like I had three eyes. I've got some big ears, Steve, but I don't have three eyes. They looked at me like I was kind of crazy when I said that because history shows there's periods of years where stocks and gold, stocks and commodities can go higher. It's not an either or, but they do help, add some diversification, but they're going to add a lot of volatility. Just know that. Again, last comment. I mean, you
Yeah.
want to go in the gold, or I'm sorry, silver, it's going to, your 3, 4, 5, 6, 7% moves on a day are perfectly normal. A lot of times people say they can handle it, and then the volatility happens, and it's a little different scenario. So just know, though, bottom line, this commodity bull market probably has a decent amount of time left to it.
Perfect. I love that. And I'm glad you really emphasize that point of volatility because oftentimes people think, oh, they're safe haven assets, right? They're
Yeah.
safe, they only go up, and that's not the case. And what the other thing I kind of took from what you were saying is that maybe a broad basket approach could be a little
Mhm.
bit better diversifier as opposed to just picking one pony and hoping it takes off and runs for you.
No, totally. Much like in investing. I mean, like growth. I mean, I'm sure a few clients of yours, Steve, probably a year ago said, Steve, why don't I just buy all Mag 7? Why am I possibly looking at small caps or mid caps or whatever,
Mhm.
anything else? Honestly, yeah, you should have just owned all the big Mag 7. How have they done this year? Not
Correct.
so good. That's again why we keep a diversified portfolio, why we rebalance, why we do these. Steve does these geeky things with you guys. You think that doesn't make any sense, Steve. And then you have a year like this when everything else is up besides those Mag 7. That's why we stay diversified.
Perfect. Well, thank you as always. You're amazing. I appreciate the time, the knowledge, the education. So we'll touch base in a few months and see where we're at and see what comes true. So thanks again, buddy. I appreciate you.
Thank you, Steve, and thanks to everybody out there for asking those great questions. I look forward to the next one. Thank you.